Welcome to this explainer. Today, we're cutting straight through the noise to show you exactly why Agentforce CRM is the next boomer. We're going to dive deep into how Salesforce is completely rewiring the enterprise landscape. Honestly, this is a massive, fundamental shift in the company's business model and growth engine. So stick around, because by the end of this, we're going to turn your AI confusion into AI confidence.
Look, right now, the market is absolutely fixated on hype. We're seeing these astronomical valuations for hardware and foundational models. But you really have to ask yourself, is the market completely missing the undeniable financial reality brewing just beneath the surface? Everyone's so distracted looking at chips, but real enterprise value? That's built in the application layer. Because at the end of the day, that is where the actual work gets done.
So let's actually define agentic AI in Salesforce CRM. And to be clear, we aren't talking about some basic chatbot that just summarizes your emails. No, Salesforce is tracking real, tangible output using what they call agentic work units, or AWs. These are discrete, complex tasks executed by AI agents right in production, literally turning raw intelligence into real business outputs, like autonomously resolving customer cases. They've already delivered over 2.4 billion of these units. The AI isn't just chatting anymore, it's doing the heavy lifting.
And this right here brilliantly illustrates their new agentic enterprise architecture. You can clearly see the distinct layers: system of engagement, agency, work, and context. What Salesforce is doing is democratizing this immense power. They are proving to the enterprise world that you need no coding, only prompt to build anything across their entire platform. That is a total game changer. They're making an incredibly complex ecosystem highly accessible.
Now, to fuel this massive AI engine, Salesforce knew they couldn't just build everything from scratch. Early AI agents kept hitting a massive wall: patchy, siloed enterprise data. So, what did they do? They took aggressive action. The recent investment strategy meant they effectively bought their way to a complete data ecosystem, securing a mind-blowing 10 acquisitions in just 6 months. It was a highly targeted shopping spree designed to fix literally every known data weakness.
And these weren't just random tech buys, they were incredibly strategic. For instance, they picked up Momentum to capture unstructured voice and video data from places like Zoom, making sure their agents actually know what customers are saying. They grabbed Qualified to lock down B2B demand, and then the absolute crown jewel, an $8 billion massive deal for Informatica. This is what cleans and connects data across the entire enterprise, not just inside the Salesforce bubble. Because let's face it, clean data is the true fuel of Agentforce.
But here's the thing. This whole technological revolution, it's not just some massive science project. It is translating directly into hard, unarguable financial numbers for the company's growth engine. We are officially moving past the flashy narrative of AI and entering the actual measurable financial reality of AI monetization.
Just look at this staggering figure: a massive $72 billion total remaining performance obligation, or RPO. For those tracking, this is essentially their backlog of contracted revenue, and it is up 14% year over year. Having a backlog this huge, growing at double digits, absolutely proves incredible future growth in backlog orders. Enterprise customers aren't just testing the waters. They are locking in and committing to this ecosystem for the long haul.
And the momentum in revenue growth is crystal clear. Salesforce delivered a phenomenal $41.5 billion in fiscal year 26. That's up a solid 10% from the previous year. Plus, their guidance shows continued, steady growth, projecting up to $46.2 billion next year. Now sure, the days of wild 20% top-line growth might be in the rearview mirror, but make no mistake, this is a massive ship, moving forward with relentless, unstoppable consistency.
Now let's talk about financial numbers and profit growth with margin, which is an incredibly important financial ratio. You see, profitability is scaling beautifully right alongside that revenue. Non-GAAP operating margins are projected to hit a massive 34.3% for the full year. That means for every dollar Salesforce brings in, they are keeping roughly 34 cents in operating profit. They're just expertly balancing heavy AI reinvestment with a highly disciplined focus on bottom-line efficiency. Okay, to keep things completely objective, we do need to address the elephant in the room: market fears. There is a very real narrative circulating out there called the SaaS Carnage of 2026. IT budgets are getting tighter, macroeconomic headwinds are definitely blowing, and investors are feeling a bit anxious about Salesforce's debt profile compared to the cash they have on hand, especially after that aggressive string of acquisitions we just talked about. And another major contrarian reality check is the whole Viva system situation. Viva, which is a massive CRM customer, basically decided to pack up, build its own system, and fully disintegrate from Salesforce. Naturally, this prompts a huge fear in the market. Is this just an isolated incident, or are we going to see other major enterprise customers decide to build their own in-house AI platforms instead of paying Salesforce?
However, you really have to weigh those macroeconomic fears and isolated turn events against the actual reality of their business. Weigh those fears against that massive $72 billion backlog we just saw. More importantly, factor in the incredibly high switching costs of enterprise software. Let me tell you, ripping out Salesforce to build your own system is painful, it's expensive, and it is incredibly risky. That lock-in effect, that is a massive structural moat.
So, what does this all mean for you? This brings us to the modern investor essence. We've analyzed the tech, the acquisitions, the revenue, but cutting through all the noise, what is in there for investor portfolios? How is management actually rewarding the people who are holding the stock right now?
Well, the answer is pretty straightforward. Management is unleashing capital back to shareholders at a historic, unprecedented rate. They literally just announced a gargantuan $50 billion share repurchase program. And on top of that, they're executing a historic $25 billion accelerated share repurchase, all while hiking their quarterly dividend by 5.8%. They are aggressively buying up their own stock because they fundamentally believe it is cheap.
And here is the real financial opportunity staring us right in the face. A grounded, base case discounted cash flow valuation pegs the intrinsic value of the stock at $264. With current market prices hanging around the 180s, it is significantly undervalued. We're talking about a nearly 30% margin of safety. The market is just pricing in way too much risk right now and totally ignoring their future margin expansion.
Look, the time is right to start building your position, but doing so requires looking past the daily market algorithms and the fleeting sector sentiment. So the ultimate question I'm going to leave you with today is this: do you have the patience and courage to capitalize on this massive mispricing and secure the right entry while the rest of the market is totally distracted? Thanks so much for joining me on this explainer. I'll catch you on the next.